Hey guys, what's going on? My name is hamishwhodder and we are back with another video. Today's video is going to be all about dividends and retained earnings. We're going to compare the two. We're going to talk about what dividends are, what retained earnings is. We're going to talk about why companies decide to pay a proportion of their earnings out as a dividend and why other companies decide that they don't want to pay a dividend, that they want to retain all of their earnings. Then we're going to get into why I personally don't invest in high dividend yield companies, just my preference. And I'm going to give you my reasoning behind why I do that and why I stick to businesses that retain most of their earnings. Then I'm going to show you how you can determine whether or not the companies you're invested in should be paying out a dividend or whether or not they should be retaining all their earnings. And finally, I'm going to show you how $1 of dividends is not in any way equal to $1 of retained earnings. If you do enjoy this video, make sure you leave a like and let me know your thoughts down in the comments section below. It helps me out a ton and it only takes you a few seconds. If you're new around here, of course, hit subscribe and join the team. But for now, guys, let's jump into it. All right, so let's start off by defining what a dividend is and what retained earnings is. Especially if you're new to investing, they can be some foreign terms and things that you don't understand about what happens when you invest in a company. So let's just start off by defining the two. We'll start with dividends. So essentially what a dividend is where the earnings of a company is paid directly to the shareholders. Sometimes companies make the decision that they want to pay out a proportion of the company's earnings directly to the shareholders. And that means that they announce how much they're going to pay per share that you own. So maybe it's $1 per share. If you own 100 shares, then you're going to receive a dividend of $100, 1 times 100. And essentially this money is just paid directly into your account. It's a cash payment from the business that you own to the owners. Now, companies aren't forced to pay a dividend. Some companies pay no dividend. Some companies pay a lot of their earnings out as a dividend, and some companies just pay a little bit out. And the other thing is also to be aware of is that if a company pays a dividend in the past, it doesn't mean that they have to continue paying it in the future. That company can decide to cut the dividend or completely remove that dividend at any time that they want. They don't have to continue it just because they've done it in the past. But generally speaking, if a company does decide to pay a dividend, it will be paid out quarterly, half yearly, or yearly. I think in the US, the most common is quarterly, and over in Australia, most commonly it's half yearly. So that brings us to talking about what retained earnings is. So if we've got dividends, which is where you get paid out directly from your company to the owners, what is retained earnings? And it's kind of a little bit self-explanatory, but it is a bit confusing. So essentially what it is it's where the earnings are kept within the business for investment. Instead of taking all of the profits from a year and just paying shareholders directly, most businesses will keep at least some money within the business called retained earnings. And essentially what they do with this money is they invest it within the business. The easiest way to sort of understand this if you're a beginner is think of your savings account as the business. So the savings account is the business and there's some money in there. Now, let's say that 1 year comes by and you earn your 1% interest. A dividend would be like you taking that interest out of that account and just spending it or putting it somewhere else. Retained earnings would be is if you left that interest within the bank account for that 1% of interest to then earn interest on interest in the next period. So you're allowing it to compound within the savings account. And in the same way, businesses that have investment opportunities will keep money within the business so that they can invest it and grow it to even more money for them to invest into the next year and the next year and the next year. So now let's talk about why companies decide to pay a dividend and why other companies decide to retain earnings. Now, I touched on this a little bit just before, but I'm going to go into detail about why a company would decide to pay out a dividend. So a company is essentially a collection of people that are making investment decisions. That's your management team. They're deciding where they need to deploy the company's money in order to grow it into more money. And one thing that happens in business is that often you will have too much money within the business compared to investment opportunities. So maybe you have $1 million of investment opportunities and you take your $1 million from the earnings and you invest it there. But it turns out that after you've invested in all of the available projects, there is still $500,000 or $1 million just sitting in cash that has no purpose whatsoever. In this case, a lot of companies will pay this out because they can't get a high return on that money within the business. So then on the flip side, why do companies retain earnings? And it's the complete opposite reason. It's where they have all of their profits that they've received from the previous year, and they're looking at their investment opportunities, and they're noticing that they have tons of opportunities to invest that money and earn a high return. So therefore, they've decided against paying out to their shareholders, and instead they believe that they can provide more value for the shareholders by investing it within the business and growing $1 into $2, because they could decide, let's just pay out that $1 to shareholders, but instead what's a better option is if they keep it within the business, grow that $1 to $2, and then that increases the value of the business. All right, so now that you've got the foundation set of what retained earnings is and what dividends are and why a company would decide to pay out a dividend compared to retaining earnings, let's talk about why I personally don't invest in high dividend yield companies. So the simple reason is that if you have a company that is paying a high dividend yield, it usually means that they're paying out the majority of their earnings to the shareholders. So they're retaining a little bit, maybe it's 20% of their earnings, maybe it's 10% of their earnings, and then they're paying out 80, 90, or 95% of their earnings as a dividend to the shareholders. And while this is great because they're returning value to the shareholders, what it really indicates to me is that they don't have enough investment opportunities for that business internally. So they're then taking that money and just paying shareholders directly. And this is not what I want as an investor. I want the company to compound my money for me. I don't want them to just kick it back to me, because if they kick back dividends to me, large amount of dividends, most of the earnings that the business produces comes to me in cash, then I need to do something with that cash. I need to make an investment decision myself. So I only want to make one investment decision. That is to invest in a great company. And then I want the company to use their money, or my money, because I'm the owner of it. I want them to use that money internally to invest in opportunities and to grow that money internally. I would rather that than they just pay it back out, because then I've got to look for another business to invest that money in. So essentially what I'm saying here is that I'm looking for an investment in a company that is going to have plenty of investment opportunities for it within the business. And essentially what I mean by that is, for every $1 of earnings they have, they can easily turn that $1 into more than $1. So maybe that's $1.50, maybe it's $2, maybe it's $1.20, and they're getting a 20% return on any additional capital that they're deploying. If that's the case, I don't want a company to pay me out the dollar, so then I need to convert that dollar into $2. I want them to keep it within the business. I want them to look at their investment opportunities within the business, and I want them to convert it into $2 or more than $1 for me. Now, of course, companies slow down over time. They lose their investment opportunities. They start to get thinner and thinner and thinner. And throughout this process, it means that a lot of really great companies are going to pay dividends. I have nothing against dividends. I just don't invest in high dividend yield companies, generally because they're at the end of their business lifetime and they're sort of slowing down and they're just sort of churning cash. They're not sort of growing anymore, or they're not growing much at least. But when it comes to businesses that are retaining all of their earnings or maybe paying a little bit of a dividend, it's great to be able to determine whether or not that company is making smart decisions, because you can work out whether or not they should be retaining their earnings or whether or not they should in fact be paying a dividend. So what we can do is we can have a look at the return on invested capital, also known as the ROIC. And essentially what that tells us is how much money are they making on the internal investments that they're making. So let's just say they have an ROIC of 15 to 20%. That means that for every dollar that they're investing, they're able to make or turn that into about $1.15 or $1.20. A really, really bad sign is if you have an ROIC that is decreasing over time, because basically what that means is that they're increasing the amount that they're investing within the business, but it's not generating a high return. So in the past, maybe they invested 100 million and they get 10 or 15 or 20 million back, meaning they get a 10 or a 15 or a 20% return. But if that ROIC is decreasing over time and it's now down to 9% or 7%, then the additional 100 million, the next 100 million that they're investing, they're getting a really low return on it. And that's a really bad sign, because it means that they're running out of investment opportunities. The absolute worst kind of business is one that retains earnings even though there's no investment opportunities. So they keep all the money within the business, they don't pay it to shareholders, and they're also turning $1 into 90 cents, or they're turning $1 into $1.03. And you, as a shareholder, you want them to keep it if they can compound it at a high rate, at 15, 20, 25%. But if they're compounding your money at 2%, then you want them to not do that. You don't want them to compound it at 2%. You want them to pay it to you, because you can stick that in a bond or in a high earnings savings account or a term deposit and get 2%. So you don't need them to keep it within the business. You don't need your money tied up in a risky business in order to earn 2%. The only reason you want your money tied up in a risky business is if it's going to earn you or has the potential to earn you 15, 20, or 25%. The whole purpose of investing is to grow your money into more money, and at a substantial rate. For me, that's 15%. That's the rate that I'm looking for. And I don't care where it's happening. I just care that it's happening. So if I want to invest in a business and they're growing money internally, they're growing the value of the business and they're growing their cash flows at 15%, they're getting a 15% return on capital, that's great. But as soon as that drops off, I don't want them to keep my money anymore. I want them to pay it out to me so then I can go and find another investment, another business that is going to compound it at 15%. Or maybe I'm looking at something else that is going to compound it at 8% or something like that. That is the whole game of investing. And essentially, if a business is not getting a high return for you, then you don't want your money tied up there anymore. You either want them to pay it out to you as a dividend, or you want to sell the stock and look elsewhere. And for the last part of this video, I just wanted to explain something that I think a lot of people wouldn't understand and wouldn't have thought of before. And that's that $1 of dividends is not equivalent to $1 of retained earnings. It's not the same thing. If a company decides to retain earnings and then the same company decides to pay out a dividend, that $1 in dividend is not the same as the $1 in retained earnings, and I'll explain why. When you receive $1 in dividends, that's $1 in cash put into your account. It's not earning anything, and in fact, it's losing purchasing power to inflation. However, when a company retains that $1 of earnings, it isn't $1 of cash, because they're going to invest it, or they're likely going to invest it. So that $1 is actually equal to the outcome of those investments. For example, if you have a bad company, that $1 of retained earnings might be converted into 90 cents, meaning they're destroying shareholder value. But if you had a good company, then maybe that $1 of retained earnings is being reinvested to make you $1.20, a 20% return. Either way, whether it's a good company or a bad company, by retaining that $1, that company is going to convert that into some other amount. Now, maybe some companies would be very lucky, very rare companies might turn $1, not lucky, but they'll turn $1 into $1. And in that case, if a company is consistently turning $1 into $1, in other words, they're just holding the cash, not investing it at all, and just keeping the cash, therefore the $1 just becomes $1 because it's in cash, then in that case, it would be equivalent to them paying out you $1 in dividends. But you can see that that $1 in dividends is cash, whereas the $1 of retained earnings has the potential to be something else because it's going to be invested. And that might be a lower amount or that might be a higher amount. And if you can consistently find businesses that are compounding your money or compounding the company's money at a high rate, then you're going to do very well over time, and you're going to do a lot better than if you had invested in a high dividend company and just got the cash paid out to you. So I hope you guys enjoyed this one, and if you did, please leave a like on the video and let me know your thoughts with a comment down below. It helps me out a ton. And of course, if you're new around here and you want to see videos, regular videos on stock market investing and strategies, hit subscribe and hit that notification bell so you don't miss out on any of the future notifications. But I hope you guys have a great day, and I'll see you in the next one.